Right, I think we're good to get started. Actually, it's just gone a couple of minutes past 11 here in South Africa. So thank you everyone for joining. This is the third episode in our six-part series, talking about how we can, as an industry, try and make some sense of what's going on and see whether we can have some plans and put some plans in place for what the future holds. So today we're talking about how to retain control of your fintech and payments business. I hope everyone can see my screen. The agenda this morning, just to quickly run through the 6-week series, then make some introductions to our panel today. We're then going to talk very quickly about the sort of market and quick sector update. And then Nick has kindly put together a number of slides for us, which will talk us through about leading in a crisis. We have some crowdsourced some questions, so rather than doing a Q&A, we'll probably do a Q&A at the end because I'm sure there'll be some follow-up, but there's a number of questions that the community has asked, so we're going to pose those to Nick and Simon and see whether we can get some answers to those. And then a couple of sort of key points really about the investment landscape post COVID-19. What funding options do businesses have, whether it be now or whether it be in the short term, and then again just follow up with the Q&A. So we're going to keep this for an hour. We're hoping to get through as much as we possibly can. As I said, plenty of time for questions. If you have questions throughout the webinar, feel free to post them on the chat. So as I mentioned, this is the third of the 6-week series. Next up, we have Mirav Harel, who's from BDO, actually based in Israel, but has consulted globally to fintechs, to central banks, and to governments as well. And Mirav's going to be joining us, talking through a game plan. Following by that, we're joined by Menli from Intersect in Germany. She leads that, as well as being a full-time, well, a part-time career coach, I should say. So she's going to be talking about how we can retain our team during this crazy times. And then finally, we're joined by George Anderson, who is actually my coach, who I've been working with for about a year or so. George is all about resilience and building a resilient culture, and that's where we're going to end the series. So I'm going to move on to this morning. So my name's Darren Franks. I'm the CEO and founder of a business called Talent in the Cloud. Joining me today is Simon Hardy from Dexable. I'm going to let him do his intro in a minute as well. And Nicholas Smalle from Apis Partners, who perhaps, Nick, would you like to start? Tell us a bit about you and a bit about Apis.
Yeah, sure, Darren. Thanks for having us on today, and welcome to everyone from whichever living rooms or dining rooms or bedrooms you're dialing in from. So a little bit about Apis Partners. We're about $1 billion private equity fund. We deploy kind of $20 to $50 million investments across financial services in Africa. Probably the last 5 years, I think we've been maybe the most active deployer of capital across the region. And we have portfolio companies that are effectively across East, West, and Southern Africa at this point in time. So we have a good insight on kind of what's happening on the ground, and it's pretty unprecedented. So thanks for having me over and to chat to you and the team.
No, that's great. Thank you for joining. Simon, over to you.
Thanks, Darren. Hi, everybody. I'm Simon Hardy, the CEO, co-founder of Findexable. We're a fintech data company. We're building out a global database, a real-time database of fintech businesses worldwide. The idea being to build out a fully searchable database for analytics, for reporting, but ultimately to open up investment opportunities and create a kind of a more liquid investment marketplace for fintech and financial services innovations.
Fantastic. Thank you, Simon. So we're going to start off just by talking through the state of play of the global payments and fintech industry, where we are today in April. I've covered this in quite some detail in the previous 2 webinars that we've run, which are fully available either on our website or on a YouTube channel. So I'm not going to spend too long talking through this. I think there's some pertinent points here. Clearly things have moved a little bit since the beginning of this crisis, but I think some of the key things here really is certainly in the payment sector. They're predicting up to a $210 billion loss in revenue over this period, just due to what's happening and drop in transactions. There was an interesting report that was produced by one of the point of sale companies here in South Africa on the day of lockdown, transactions reduced by 90%. And I don't think they've seen much of an upturn. That particular company has pivoted, and we'll talk about some pivots a bit later on. So hopefully they've managed to increase some volumes elsewhere. But clearly there's been a move away from cash as well, not only because there's a bit of fear around the actual sort of physical contamination of the cash, but also people are forced now to use online payments, which is obviously a good thing for our industry. So we'll see how that pans out over the next sort of 3 to 6 months. There's obviously been a bit of a spike in some e-commerce. I mentioned on the last webinar that there's some products that are literally flying off the shelf. Bread makers, one of the top consumable items that you can't get your hand on for love nor money. There were some other things like weight training equipment as well. So there's certainly some nuances there. But and I guess in different locations, different countries, there's certain things you can and can't buy. Obviously, here in South Africa, it's extremely restrictive. Hopefully that will get relaxed a little bit over the coming couple of weeks. Simon, Nick, anything on this in terms of what you've seen at the moment? Are we moving from kind of lockdown to countdown? I did take that phrase from someone else, by the way, and I can't remember who, so I can't attribute it to that person, but I thought it was quite apt. I'm very much looking at this as a countdown to some degree of normality. Is that your views, or do you have something else?
I mean, maybe I'll jump in. Yeah. Look, I think what we'd say is, I'd separate the corona-related slowdown to the ultimate consumer-related slowdown that comes behind that, right? And it's true that, I guess, as far as coronavirus and the containment of that, we will move down from lockdown through countdown to an eventual opening of the markets. And that will be, 2, 4, 6 weeks, whatever period of time there will be behind that. The unfortunate thing, I think, is that the real pain will come there afterwards. Most of our economies are largely driven either on commodity prices or local consumer demand. Both of those have been significantly impacted. The loss of jobs have been severe, and we're still only at the early stages of that. So, I mean, we look beyond, I think, kind of the immediate aspect around, think about really the detriment of the economy. And I think what we'd be saying is that, we'd see an economy 50 to 70% of pre-COVID volumes over the next 12 months at least, much longer, kind of, I guess, what the industry is calling a swoosh-shaped recovery. But not the virus, it's about the recession there afterwards.
Okay. Yeah, I'd agree with that. I mean, there's this there's this talk of this dance, isn't there, in terms of the actual virus itself, this kind of releasing of restrictions, making it easier for people to go back to work and opening up. But then that's going to lead to a rise, potential rise in infections. So I think what we're going to see is longer term changes in the way people think about doing things, particularly shopping and carrying out their daily lives. But I think also in emerging markets, if you look at a graph in the FT yesterday, which tracked financial withdrawals from emerging markets, coronavirus versus 2008 versus 2000, and the sort of emerging markets crash of the late 90s, and the numbers are scary. There's a lot more money has been taken out of emerging market funds this time at a much faster pace than previous, and that's going to play out in all manner of ways across all emerging regions.
Absolutely, I would certainly agree with that. So we're going to talk today about retaining control of your business, whether that be a fintech or payments or associated. And I think there are a number of areas that we can control, or you can control, and there are a number of others that obviously are beyond anyone's control or sphere of control. So if we look at sort of the core areas of a traditional business, so we have the sales and marketing, human resources, operations, support, fraud and risk, and then finance, which I think we'd like to spend a bit more time talking through today. Nick, from your side, is there anything else that one can control within a business, aside from what I've mentioned here, or is there anything you'd like to elaborate on before we move on to the finance side of this?
I mean, we can pick this up a little bit in where we talk about later on, but I mean, these are your kind of effective spheres of control.
Yeah, okay. Perfect. So I'm going to hand over now to Nick, who's been very, very kind in sharing a deck with us that they use for their portfolio companies and have used over the last few weeks in order to help them get through this crisis. So Nick, over to you. Just give me a nod when you want me to move on slide by slide. Shall I move to the first one?
Yes, please.
Yeah, okay.
So just for kind of everyone, I mean, ultimately, when we're thinking about scenario planning, we are ultimately assessing that against a plan. And so we've spent a lot of time with our executive teams in our various portfolio companies to effectively model what we think would be a kind of potential trajectory of Corona and then the subsequent recession related to that. I mean, I think the guiding principle is, prepare for the worst and hope for the best. But that is really kind of where we would take it. So maybe just to kind of go on to, the slide. I think a key thing, obviously, and you can turn on to the next slide, Darren, from this, is around the fact that we are, obviously still seeing a significant spike overall within the various corona-related diseases, but really the impact is kind of filtering through in, I guess, 3 stages, right? And one was obviously China, which was much better contained. Now we see the US and Europe, where there's sufficient fiscal headroom to support the economy, and I'm sure many of you have read about the multi-trillion-dollar fiscal stimuluses that have been provided to small to medium-sized businesses, consumers, and I read today just in the UK, even startups are provided a £1.8 billion pool of capital. And then therefore you move on to kind of the third space, which is emerging markets, where I think with regards to kind of, let's say, the pathogenicity of the disease, there's a lot of indications that say because of early stage vaccinations like BCG, because of a warmer climate, we might not see the same degree of pathogenicity. But the most important thing is that the fiscal headroom that is available to consumers as well as governments is much, much more narrow than you would see in the developed markets. And that's where we're really focused on kind of what businesses would be able to do. An interesting statistic, for example, is that the average SMB only has sufficient amounts of cash to stay open for about 45 days. So once you start getting over this period of time, actually you're in a situation where those businesses haven't got enough cash to restart. And regardless of what happens with regard to a lockdown, those businesses will be kind of perpetually out of trading. And so that's why we do think that the peak in emerging markets could be kind of quite severe, not to the disease, but to the economic fallout. On to the next one, Darren. Yeah, I mean, this is just a quick context about, the US unemployment, and I think that we'll see this replicated almost in any other market. And the short story here is that the degree of workers being driven through unemployment and furloughed is really, unprecedented. Obviously, the knock-on demand here is that, if you use an economy like South Africa, about 70% of local GDP is driven by consumption. What isn't driven by consumption is driven by exports. Those exports are either soft or hard in nature and are mainly to developed markets. So there is a kind of knock-on effect here that happens through really taking US and European consumers effectively out of the global context. So, in 1 month, we've effectively undone 12 years of employment in the US. Wow. Next slide. And so you see this in terms of the institutional flows in the emerging markets, and Simon was talking to this, but effectively when we see investors with at least in something like a liquid asset like fixed income, outflows in fixed income, again, have been unprecedented, much, much more than the global financial crisis at any point about this. So this is a complete risk-off environment. Again, many of the markets have seen the treasury bills kind of soar 200, 300, 400 basis points. And that's kind of where money is being allocated today. And this obviously has a knock-on impact, right? What's happening in fixed income is happening in equities, happening in the startup land, is happening to investors' exposures to limited partners and GPs, and therefore their ability to fund businesses. Thanks. The joys.
You got an audience.
I do. I have a crazy 2-year-old, yeah.
Somebody's not happy with the outflows.
He's not happy about that at all. On to the next slide, Darren. And then, so we talk about, I mean, so no doubt that what we see in front of us is unprecedented, but how long should we be thinking about the type of recovery that we see in front of us? And so, you know, you guys have all heard different types of acronyms or letters, you know, L-shaped, V-shaped, U-shaped, Swiss-shaped, whatever. I think, you know, if we at least look to like
Nick, we've lost audio from you.
Is that better?
There we go. Yeah.
Sorry. What I was just saying is that, you know, the next thing to talk to is, you know, how long will this go on for? And so we've all heard, you know, the various type of alphabet soup of recoveries, you know, L-shaped, U-shaped, V-shaped, whatever. But I think one of the key elements here is that if you look at a historical context, what we've seen is that this is very much a structural recession, although it's event driven with regards to the nature. The loading up of debt and the unwinding of kind of quite a highly levered society is much more structural. And if you take that view, what you've seen from the bottom is roughly that there's been about 111 months to recovery. So, you know, we see 9 years from peak to peak for the average time. So it doesn't mean that that's how long it'll go off, but it does mean that these type of situations can take many, many years to play out. So from 2009, you know, it effectively took us to 2016 to get back to kind of the same type of levels that we had seen in the S&P. And this is just kind of a last slide to end with, and I don't really mean to be kind of doom and gloom, but I mean, I think as we had said, it's best to plan for that. But I mean, there are going to be many false rallies over the next, you know, 1 to 2 years. You know, the classic kind of saying is that it's not a bear market without a bull trap, and that's 100% accurate. So, you know, we will see narratives around kind of the reversion, potentially picking up, a bottoming out of the market. But markets will take some time to find their kind of bottom. And so, you know, ultimately, I think when you take all these things in context, and I'll wrap this up at this point in time, is that, you know, we really are telling our executives to firstly focus on liquidity over the next 3 months, need to survive and have sufficient amounts of cash. Then we're talking to them around restructuring their business operations to run on a leaner model so that they can extend whatever runway or whatever profitability they have there afterwards. And then there afterwards, we're talking to them around really trying to take the offensive and thinking about that the market that they will operate into will not have a surfeit of capital supporting kind of poor business models, but that the stronger kind of businesses will ultimately emerge. And so if you actually move on to the next section, Darren, what we'll do, and I'm happy to share this with everyone who's joining, but we have kind of spent a bit of time with our executives to give them, you know, just a rough and ready framework of how to think about this. And really the thing is that it's very much as Darren had mentioned, which is what is in your control and what is the impact on your business. And immediately in the next 30, 60 days, you need to focus on the things that have a high impact on your business and are in your control. So this is costs, like extension of receivables, debtors, etc. Then you need to start figuring things that are outside of your sphere of control, but that, you know, do have a high impact on your business. Things like funding, the market you operate in, etc. And you need to delegate things that are, you know, within your sphere of control, but have a low impact. And this should be put out to your executive team or your N-2s according to that. And this should all be wrapped up in a crisis management kind of framework, where really it's all about communicating within your executive teams on a much, much more frequent basis, and having key check-ins on this to kind of really survive what is quite a difficult time. You know, below this, and if you go on to the next slide, Darren, we've taken these kind of aspects into, well, what do we specifically mean with regards to liquidity, financial structures, legal, regulatory, etc. And again, we'd make this available there afterwards. So with projects, what do we mean? We need to put a break on all projects, put a list on everything on the table, review and prioritize, stop loss-making initiatives. And really, this is what we've taken our executives through in the first 2 weeks, just to get a handle on the business, and thereafter make plans from that.
Okay, thank you. Nick, just a question for you before we go into some of the other questions or some of the other points we've raised. Obviously, engaging with your executive team, where typically they've probably been in an office environment. Everyone, as you mentioned, is either in their bedrooms or in their living rooms or in their sheds. How difficult is that, and what challenges does that pose when you're dealing with something so fundamental like this and such a massive impact?
Business continuity has not been an issue. I must say, I think that one thing we've learned from technology-focused businesses is that, we're not banks, we're not insurers. When lockdowns were put in force, yes, there was some change that was required, but on the whole, most of the business successfully executed. I think probably the only exception to that was where we had, staff that, let's say, never had like internet access that the way would be needed, or where those staff were in call centers. But what we've generally found, because we invest in financial services, is that most of our businesses have been classified as essential, whether that's true or not. So we've been able to maintain call centers to a certain degree as needed. But yeah, business continuity, I think, has actually been quite robust given the scenario.
I mean, there's an interesting point, isn't there, that technology companies in particular that were remote in terms of their operations, generally seem to command a lower valuation than a company based in a one location with all its people in one place. Do you think, sort of coming out of this, it may be too early to say, but do you think that view of the value of remote businesses versus companies that are based in one location is going to change?
I don't actually. I mean, I think that at least from what we've seen, I mean, we have companies that are fully remote, and have sailed through this. I think about a business like Tutuka, where we're invested to, and they have, staff effectively globally. I mean, I think where investors are focusing is on the business model and unit economics, right? And that the staff complement would actually play less of an importance going forward to where you're based. Maybe at the edges, investors will start to think that, not having kind of an office is an acceptable solution, but I really think that's going to be at the margins of any investment decision going ahead.
And from the market sort of rally and re-rally, do you get a sense of how far, are we have we reached the bottom, a floor, or is there a kind of dead cat bounce scenario where we might see another dip?
I mean, I'd be making much more money if I knew the real answer to that. So, look, I think what we can say is that generally, what we've seen in judging by the past is that, for the type of unemployment figures we're seeing, for the type of contraction in GDP that we're seeing, we should see a much deeper reduction in stock markets over the period of time, right? So, I mean, the S&P is now really only down about 15 to 17% from a peak. So, I mean, I'm saying I don't know, but judging by past behavior, it would seem that, there's still a ways to go down.
Yeah.
I was reading this morning, probably at 4 o'clock this morning, because the hours just roll into one at the moment. But the oil price, certainly in the US, I mean, it's now a negative figure. I mean, that's
minus 37,
madness.
I think.
Yeah.
Last night.
What sort of impact is that going to have if we talk about sort of a macro level?
So I think, look, I mean, the volatility that we see in the markets, what that's going to mean, I think, for most of the people on the call is that, the pool of capitals you have available to you has narrowed significantly. So, in an up market, what you find is that you have many people who are either able to raise fund or access funds and can kind of, build an investment mandate around that. In a volatile market like this, those pools of capital are going to narrow. So where before, let's say you would have, due diligence with 30 investors, it's going to be 15 investors now, or 10. And it's going to be investors who this is clearly on their mandate. You are in the right market, the right sector, the right area. What I see from all investors is a complete pullback to what they know. I mean, at the end of the day, private equity and VC is sitting on a record amount of dry powder. Their job is to deploy, but they are deploying kind of close to home and what they do know. And they're deploying it into business models where both on pricing as well as on understanding the underlying business and unit economics, they're much more diligent on than they were past. I think the downside for Africa is that, if you look at how much capital is deployed in the continent, a lot of the times we are kind of the edge case with regards to investment. The purely Africa-focused late stage and early stage VC pools are small relative to, let's say, the Chinese or Japanese money or the occasional large US fund that's coming in. And that money is going to be much, much more difficult to get there. So whether it's the oil markets, the S&P, the VIX, that volatility in an investor's lens just means they're going to pull back to things they know and understand better.
Are you seeing that the deployment of capital is going into existing portfolio companies, propping them up, as opposed to making new investments? What's your view on that?
100%.
Yeah.
So most of the peers we talk to, ourselves included, we're working with our portfolio companies to I wouldn't say prop them up, but to manage the situation. There is a real benefit to having a supportive backer during this period of time, because you can effectively share if your business model is right. Most kind of investors are supporting their portfolio. And I also think it means that, if you're fundraising at this point in time, you have to be cognizant that people are at home and they have a lot of time on their hands, but that their priority is going to be on their portfolio. So, what we, at least when we're talking to companies, is we try and have quick no's at the moment, because we know that people's time is valuable, and that really they don't want to go down a dead end and kind of go around fishing. And I would encourage kind of any company in this space to think about that your time and the availability of cash that you have is supremely valuable. You need to get to know those really, really quickly.
Thank you. So I'm going to move on to some questions that we've kind of crowdsourced. And apologies for that blurry image on the left-hand side. I just couldn't resist putting that in. I saw that last night on LinkedIn. So I'm going to pick a couple of them. I'll see how many we get through. But you mentioned earlier on about sort of a large proportion of companies having sort of 45 days of sort of cash or headroom. What would you say a business should typically have? Is there a general rule here? Obviously, it depends business to business and how liquid they are. But is there some sort of guidance you can give, Nick?
So, when I say that, I would mean this would be small to medium-sized businesses like restaurants, right, that don't have investors behind them. But ultimately, they're customers for many of us, right? So whether you're in the acquiring space or the payment space, their demise is, ultimately going to take a knock on yours. So I don't think many of the businesses that would be on the line now would be in a similar type of situation. But, if you have a J curve, and you're still funding losses, what we've generally seen is your range of kind of cash would be anything from 8 months to 18 months. That's the typical amount you'd be raising. And embedded in that would be a growth trajectory, a hiring trajectory, etc. So when you put that all on halt, so we're not even talking about kind of taking costs out, we're just talking about not incurring fees. We're going to take that 8 to 18 months and you're going to stretch that to roughly 12 to 13 months. And that should be the first kind of point of call. So sure. I would imagine that most businesses we're talking to are going to be in that 12 to 13 months kind of cash flow range.
Is that what, I'm not going to ask you for a recommendation.
Your first question is easy, and should you cut deep and cut fast?
Yeah. Yeah, sorry, Nick. Yeah, please go ahead. So there's a bit of a delay on the line.
Sorry. So I think what our advice, at least to our portfolio companies, has been is that it's very difficult to be knee-jerk now, certainty of what is likely to happen. But at the same time, you can't kind of sit on your hands and wait. So our general playbook has been to obviously stop all non-essential hiring. Sorry about that, Darren. I know that's not in your best interest. But that would be one key element of that. Also, all non-essential spend on capital products have also been pushed out, etc. So that would be one element. So we're taking all future costs out of the business. The second element would be obviously to take all current costs, which are easy to remove. So things like travel, marketing, effectively any of these costs around that. And then what we've also done with, and not ourselves, actually what many of us executives themselves have taken on is effectively across the board kind of salary deductions, right? So ranging from 20 to 50%. For most of the businesses, people costs are 60 to 70% of your total costs. So if you're not making a reduction there, you're really not extending your runway. But I think what most guys have been aware is that at this point in time, it's really hard to know what will be restructured and what will be needed. And so the average executive has probably taken 3 months of salary reduction across their executive team and their junior staff, and is using that 3 months and that buffer to strategize around how to restructure their business operation should kind of, the client base not open up. So, an example would be, if you're operating in South Africa and day 2 or 3 after the lockdown, you find out that 25% of your clients are not open, then you can then think about how do you need to right size your business operations. And so, good executives are optimizing their businesses now by conserving cash, but retaining optionality. And then secondly, they have very clear trigger points around when they need to make decisions. 1 week after lockdown ends, 1 month after lockdown ends, 2 months after lockdown ends. And all of it is around retaining and managing that liquidity in their business as a whole.
Great, thank you. Some really good tips in there. Thank you, Nick. We probably already touched on, the best way to optimize costs. So, looking at that matrix you put together and prioritizing, which ones you can tackle straight away, and which perhaps you can give a slightly longer term view to. But let's just talk, if we can, about some of this was a question that actually 3 separate people asked me in terms of what sort of traits does a founder, an entrepreneur, an executive within a business or leading a business during these times, what sort of traits they need to have? And Nick, we mentioned yesterday, there's probably a few people on this call who are leading businesses that have never been through a recession before, or this is the first time that they've led a business through a recession. What sort of tips or advice would you give? And Simon, feel free to chip in on this as well.
Yeah. So, I'll give you a bit of a sense. I think the first and foremost is that the good CEOs make decisions. They realize they don't have all the information available to their hands, and that the information is uncertain. But the best executives we have try and make a decision on the information based in front of them, and understand the trade-offs between making a decision. A perfect decision made 1 month late is effectively a bad decision. So I think that's one key thing. So that bravery, I think, needs to be embedded. Second thing is transparency. Your staff understand that we are in unprecedented times. And so, controlling this and keeping the narrative very close to the executive team is really kind of not useful. And so that transparency across the organization and the ability to pull people together, I think, is very, very critical. And good leaders, I think, know how to balance the fact that they need to be transparent with their staff, but they need not to share so much information that your staff effectively go into a tailspin and are unable to operate, right? And there's a very fine balance between those two aspects. I think that's a key element around that to do it. And then I think a third thing is that good CEOs realize that, they need to actually pull in experts from their business to help them make these decisions. So what I mean by that is, your CFO, it's not just about reducing costs, it's about optimizing working capital, right? He needs to understand which suppliers he can call to push out payables, which debtors he can call to push in receivables, etc., right? And so, I think good executives will lean on their kind of key lieutenants and bring them into the decision-making in a very rapid and iterative way. That I think is very much kind of the key thing around here. Again, our focus has been very much on liquidity. So making it through the next 3 months so that you can strategize how the world looks there afterwards and plan from there.
Great. Yeah. Simon, anything to add onto that?
Well, I'd agree, wholeheartedly with everything you said there. We published, actually, and I'm happy to share it, Darren, with you and the guys on the call. We published a kind of CFO top 10, a sort of 10 sort of key tips, which a lot of what we've just said, what you just said there is included. I think the balance is absolutely right. Certainly bravery, but the humility around these sort of situations. I think what's really interesting is the kind of the human side that's sort of being forced out of us because of this. We're working from home, so there are kids and pets and vacuum cleaners in the background. But use that. There's an opportunity to use that to kind of relate to your staff and your teams. To connect with them. Having to do everything remotely is a challenge, but as we've heard from the previous couple of weeks of of these webinars. You can connect. You can still use it. It's still a valuable, viable medium to connect with sort of key members of your team on a one-to-one basis, and absolutely share with them the information that's needed, but also do the usual poker face thing, and lead these people through difficult times. There are going to be opportunities also. Providing you're not in a desperate bid for cash, and you have got resources at your disposal, or an ability to look at new opportunities. There are substantial opportunities that will come out of this, and start to galvanize your team around what those might be, because it's not all, there's a lot of doom and gloom out there, but a lot of that is because of the uncertainty, and we will come out of this, and as the world starts to reopen, people will start to see that yes, there are some opportunities, and there are things, particularly if you're in technology, that you can adjust and adapt to.
We've spoken about bravery here. We've spoken about, I suppose, readying or right-sizing a business. And I guess I'm going to combine two questions here, and then we'll move on. But, when we talk about pivoting, or when businesses talk about pivoting, I'm not talking about moving from, being a payments company to being a restaurant. Well, that's a very good example. But, can you pivot products? Is that a wise thing to do? How much time, effort, and how much capital should you put into that? So that goes on to probably the second question here, which is, when should you pull back versus when should you push through? Views on that, Nick?
Yeah, I think, so when we see kind of pivoting, and I mean that, I guess, in the incremental sense, and not in the sense of you were saying payments to like a restaurant business, yeah. But ultimately we're all in business to serve our customers, and our customers' needs have changed, right? If within our kind of company and the resources we have, we're able to meet those obligations of the customer, one aspect is obviously that it can buffer some degree of cash flow, but it builds loyalty long term. And so, I think that some of the best executives we have now have recognized that, right? And have recognized that their customers are in a different scenario. You speak about a couple of payments businesses, but I would say, we have an impulse business, Ikoka, and what they realized is that the businesses that will stay open in essential services, don't have sufficient amounts of gloves, masks, sanitizers, etc. And they effectively procured a lot of that and delivered it to them, to those merchants that were open. Obviously other kind of payments businesses have gone the route of providing gift card services. So that's small. I think in South Africa, you see this quite frequently, that actually a few of the gift card businesses are moving into allowing you to keep your favorite small business open, etc. So I think that kind of incremental, is it going to kind of complement your cash flow? Probably marginally, but is it going to build long-term customer loyalty? Indefinitely. And that is actually way more valuable. So where your customers are and where they're under strain, if you can kind of facilitate that and open it up, it's a really great win. Yeah. I think also just... Sorry.
No, I was going to... Go ahead.
I'll just say also, in terms of pivoting, another aspect that we've seen is, quite frequently, many of the businesses on the call will be reliant on third parties for integrations, etc. And I'm sure that many of them, from a technology perspective, would have had, long delays around getting on the technology roadmap of XYZ customer or supplier or payments partner. And what we've seen now is actually in this kind of slow down, the tech teams have more capacity because they're not doing so much maintenance. And we've taken advantage of that. So where we've had key partners and we could support them, we prioritized kind of the integrations with them, and facilitated that through some degree of kind of cash payments, etc. So there's a lot of ways, I think, to think differently about how you grow through this period and how you take advantage of it, that just require a little bit of lateral thinking.
Yeah, on the pivot front, it absolutely. You mentioned earlier about taking out costs. The really difficult thing, for us as a small company, for example, is knowing obviously where to focus in this sort of time, but also knowing that that sales, direct sales, aren't really an option. We need to be sensible with the money that we've got available at our disposal, but we've also got to maintain a presence. And as much as we would like to kind of withdraw all the marketing spend, we need to be seen to be out there still. And I think that's that's a really interesting dynamic, which is, where does one, just to think quite carefully. I'm not saying to use our model, but to think quite carefully about where one does draw the line when it comes to taking out costs, because this is an opportunity to build relationships, to build brand equity, to build build presence in the market, so that you can come out of it, and then ideally capture some of the benefits that it will create. But it's a difficult balance.
Yeah, well, I think to that, I mean, and you're just using this as an example, right? I mean, Darren and the team have done a webinar series on key elements that their clients and customers are thinking about, right? This obviously is much cheaper than, let's say the alternative, which was, some conference somewhere that had everyone sitting on their phones. So I mean, these two things are not agnostic to one another. You can keep a presence and you can keep top of mind with your customers by producing or making or assisting with relevant material for whatever trials and tribulations they are in at that point in time. It's not either or.
And Nick, I think you and I sort of agreed yesterday, it's a really good opportunity to get through that to-do list that you've had. So all of the sort of slightly lower priorities that have been building up for a couple of years, it's a good chance to sort of tick those off. I'm not going to plug anything else we're doing. I'll wait for a later date for that. This is not the time or the place, but let's move on. So, we talk about funding options. If a business is really strapped for cash, what are the options? I appreciate different markets and there are different options. You look at the US or you look at the UK, where there are stimulus packages. But obviously that's not really available here. I know there's some talk from the South African government about subsidising some things, but it's going to be minute. So what options do businesses have?
So I think, look, I mean, first and foremost is the cash you have and the control you have over that. We spoke a lot about optimizing working capital and OPEX. I mean, that goes back to the matrix control, what was in your frame. The second aspect around that is where you have external sources of financing, so banks, etc. There has been a proclivity with banks to effectively roll interest payments, etc. So, anything that's contractually agreed, and this includes rent, what we've seen is many people have gone and renegotiated those contracts. So it's not even just about optimizing what's in front of you, it's changing the terms of engagement. All of that ultimately facilitates and improves the cash pool that is in front of you. I think, again, also many businesses have effectively gone the route of asking key suppliers if they would upfront provide payments for lower cost, right? So if you were on a SaaS model, do you go to your customers and say, look, we'll give you an annual license fee, but at a 30% discount if they were sufficiently cash flow? So I think that's, again, with the kind of key view of do what is in your control to do, and think kind of, very broad about how you can do that. I think then once you kind of get outside of that and you think about, well, let's say new sources of capital to your business, whether that's, debt or mezz or equity or, even kind of grant related aspects around that. And I'm going to take kind of, let's say, the government stimulus packages off, because those would be very specific to each country. And I think you're right, Darren, in Africa, they are quite limited. I think I would say that, probably quite comfortably, you're not going to get a new investor that you've never spoken to before to invest in your company within a 6-month time frame today. The truth is, I think with the travel ban is going to take much, much longer than even the local lockdowns. People are focusing on what's core to them. So I think a good place to know is like when not to start. And those kind of conversations can go on ad nauseam. So, if I was a founder, I would kind of go through the Rolodex of people who've really walked through my business in the last 2-3 years, understand me, the guys who've had, a quarter or once every 6 months touch in, guys who are thinking about maybe raising money from in, 6 or 12 months. Those are the people that you need to be kind of talking to and building a relationship with today now. Then I think the second thing, it obviously comes to what type of terms. Cost of risk has gone up, valuations have gone down. I mean, I think across various markets, different markets reset at different expectations in terms of pricing. The US market, for example, very quick because of the amount of deals in the market. We find generally emerging markets actually reset pricing quite slowly. What that actually means is that founders who get ahead of the wagon and kind of engage early and are willing to kind of realize that there is a lot more security in having cash in the bank today, and are willing to do that on terms that make sense, are actually going to benefit. The guys who hold out for 6 or 12 months will be caught up in a whole big rush around that. It doesn't mean you have to kind of give up views around valuation, etc. But I do think that, this is when you need to start engaging your CFO and your team about kind of structured equity, etc. So either where, if you overperform over the period of time, you change the valuation retrospectively, or you have effectively a milestone-based payments where, you get something over the first 6 months, etc. It's all about ultimately is who's taking what risk. And so I'll give you a very clear example of what we're doing here at Apis is that we have businesses that say, look, we don't know how long Corona is going to go on for, 3 months, 6 months, 12 months, but we have a good business model and we're structurally advantaged and we want to take advantage of that. And so a very kind of transparent conversation between us and them is like, well, who is taking the Corona risk? If the economy, let's say, is 3 times worse than we expect, should we take that risk or do you want to take that risk? And ultimately, there's an impact on timing, because the more you force an investor to take the risk, the more they're going to wait in terms of doing the timing. And so we've just been very clear with guys to say, well, look, we will deploy quickly if you're willing to internalize that risk. And what that means is you need to come up with a new business model that takes Corona into account. You need to put that in front of us and be clear about what the milestones and objectives you hit. And if you hit them, then we'll play catch up on the valuation later. And so we're happy to invest quickly in businesses that can outperform structurally through Corona, and effectively move that along. And ultimately, each entrepreneur needs to make that trade-off themselves. But I would say, if you think the investors are going to make that trade-off, what you'll find is that the funding rounds are going to drag. And now you may be in a position where that's actually something you can accept. Fine, then don't take the discount. But if it's not, it is just always about risk transfer and who's taking what risk. And there's always a legal way or contractual way to move those risks around in a way that optimizes what's most important for the business now.
What sort of, Nick, what sort of opportunities are you interested in? Or another way, at what point do you think would you start to look at opportunities in a more serious way?
So we're actually very active now. I mean, I think honestly for Apis Partners, this is a great time. I don't mean to be cavalier, but the benefit of being sector specific experts, or let's say not experts, but let's say proclaimants of that, is that we do have a view on what business models we like. We do have a view on what business models are structurally aligned with kind of, let's say, the way economies are moving. And we think that, once Corona blows over, probably your business plan is 1 to 2 years behind where it was, but you're still there, right? And those are still kind of advantaged businesses. So right now we're investing in businesses we're very long on the online payment space. We're very long on the acquiring space. We're very long on the integration of various SMB tools. So whether you're an independent software vendor that's rolling in payments, or whether you're effectively a table-based POS, these are all things that we think are the direction of travel. And so we will be quite comfortably kind of invest there today without really worrying about it. I think what we do see, and again, this comes to, is that investors are retreating to their core. So this is our core, right? Emerging market financial services. Where we're not looking is where we were, let's say, in the past doing stuff like a bit more peripheral, micro insurance, business models that haven't really been proved yet. So even in our business, we're seeing that. And so, the same is true for, our peers who, let's say, were US-based funds investing globally. They're much more focused on the US market or the European market now than they would be on the African market.
Mm-hmm. And are you seeing any sort of interesting patterns between one emerging region and another? Any sort of synergies?
I mean, not particularly. Look, I think the kind of trends that behind that were there before, especially in the payment space, are well embedded and aligned. I mean, if anyone looks at like fintech investment, it's the reason everyone's on the call here, right? In the last several years, it's been kind of it's been well understood that this is a key trajectory and trend. I think where we are more focusing in about is like, what has COVID done that structurally changes business models that, let's say, weren't as advanced as, let's say, financial technology? And so then we look at things like the digitization of education, government, healthcare. These are probably three areas where, from a regulatory perspective, there was too much red tape and inability of consumers to actually step into that we think would change, right? So if you were providing payments to those type of businesses, there may be new options to you. But I think that, like I said, COVID probably pushes everyone's business plan out 2 years, but doesn't change the nature of the travel.
Right, thank you. I'm going to move on to the last question, then open up if anyone's got any questions. So if we look 1 year, maybe 2 years, however long this thing is going to go on for, well, you may have answered this already, Nick, but what do you feel that the landscape's going to look like for investment post that? You mentioned valuations are probably going to be suppressed somewhat. At what point do you think we're going to see a rebound? Do you think there's going to be a different appetite for investment? Obviously, Apis Partners is actively searching for opportunities. Is that the same across peers, across VCs, across angels? What are you seeing now, and how do you think that's going to change?
Yeah, so I think realistically, I mean, the way, obviously, if we take the big pools of capital, private equity, VC, high net worth individuals, the truth is for the two of those pools, so private equity and VC, most of the money has already been raised, right? And the truth is, I think that 2017 through to 2020 was maybe some of the best times in terms of raising capital in our industry. And many of those guys have not deployed. So there's a lot of dry powder, in fact, a record amount of dry powder that's sitting on kind of the sidelines. This is on a global basis. So I would say that, over the next 24 months to 30 months, deals will continue to be done. They will be more structured. There will be at different valuations. There will be capital to be deployed. Where you'll start to see a dip is probably, let's say, 24 months or 36 months there afterwards, because people who are raising money now in this market are going to battle. And those would have naturally been the people to deploy in like roughly 36 months. So that's why I think, now is a good time if you're an entrepreneur to get ahead of the race, kind of raise capital of those 24 months, because, our industry is going to struggle. We're always a lagging indicator in 24, 30 months from now. And thereafter, depending on kind of the speed of the recovery and the depth of the recovery, we'll probably see a bit of a bounce back. I would say that this is global in nature. I think realistically that the truth is that a lot of GPs in Africa have struggled in the last 2-3 years. I think about kind of our peers at other private equity funds. Their returns have not been that strong. The ability to raise money in good times has not been that high. So, I would say that there's probably a decent amount of capital if you're raising $1 to $10 million. If you're looking to do more of that pool is quite small right now, I'd say.
Okay, thank you. I'm going to open up to any questions if anyone has any questions. There we go. We've got a couple coming through already. So Vincent, thank you. What would African-based fintech startups need? Sorry, I just moved my screen. Can't read that. What would African fintech startups need to do better, or rather improve on, to easily and affordably access funding and investment even during the pandemic period?
So, I think, what needs to what we see quite frequently now is that there is a movement away from, let's say, buying market share, which I think was kind of, let's say, 2018 to 2019. So guys like OPay, etc. Many of these wallets that are being built across the continent, let's fund the CAC for 2 to 3 years, and then let's build a ubiquitous network that we can then monetize. I think if you were in that type of business model that effectively relied on another 2 to 3 rounds of fundraising ahead of you, I would get out of that. I think where you need to get to a business is where, you have very clear CAC, you have a quick ROI, or let's say break even on that CAC. We're talking 9 to 15 months, and you have kind of a churn rate that's manageable against that. So what you'll see is, I think investors are going to focus much, much more on the business as it is today and the unit economics as they are today or will be in the short order, rather than there's 150 million people in Nigeria and that's a great opportunity and it's tigers rising or lions rising, whatever McKinsey writes about that kind of stuff. I think those kind of pie in the sky stuff is just, those businesses are not going to be funded. And if you go to investors pitching that, they're not going to listen.
Thank you. Is there any other questions? Vincent, I hope that answered yours.
I mean, Nick, the challenge for sort of building scale businesses in general, especially technology businesses, not just fintech businesses in Africa, is just is this whole problem of regulation. There being no, not yet, although there's been moves to it, to free up trade, to do businesses between African countries. Do you get a sense? You're not in regulation, government, I appreciate, but I mean, do you get a sense there's going to be any kind of massive change in that in the next couple of years because of what's happened with the pandemic?
Yeah, I think there's no clean answer for the whole of Africa. I mean, each country faces different speeds and inputs, etc. Look, I would say that from a government perspective, my expectation would be, or at least my hypothesis would be, over the next 12 months or so, governments are very much focused about dealing with the fallout of COVID, and that actually kind of headspace for new policy will be quite limited if it never directly impacted that. So I would say that going into this, I mean, and I'm sure most of the entrepreneurs would agree, is that, regulations have not really been an enabler of businesses in Africa. I don't think that will change. But I guess at one level, they may become less of a hindrance.
Yes, let's hope for that.
Gentlemen, I think we'll wrap up here. Thank you both. Thank you very. Oh, hang on, sorry. There's one more. I think we've got 3 minutes left, so let's answer this one. Vincent, yeah, that's very insightful. So basically, the take is the business models will need to change and be realigned to the current times.
Oh, those are 2 words.
Yeah. I think that's a kind of good summary out there. I mean, practically there will be more businesses looking for funding and smaller amount of investors, so the demand supply balance will change. Which means, yeah, I mean, you need to make do with less, I think, is kind of the aspect around it. But I do think that, I mean, again, from an entrepreneur perspective, and I'll just put this out there, the way we try and guide our executives is that the worst competition is competition that is kind of funded indefinitely by cheap money, because it actually fundamentally breaks your business model, right? So if someone comes, let's just think about payments, and says, I'm going to give away this business at below MDR, or let's say below interchange, because I'm going to monetize in the long term off some advertising, revenue. That may be true, but by the time they get there, they would have broken your business, right? And so there is some value to some degree of normalcy returning. I'm not saying that this was not prevalent across the continent, but there are kind of key areas, I think specifically in places like Nigeria and the wallets, where, an awful lot of money has destroyed actually some really good businesses. And so I would say from an entrepreneurial perspective, if you are on the rational side of that, you're running a good business with good economics and clear pathway to profitability, this can be a benefit to you.
Oh, absolutely. I think that's absolutely right. I mean, I think technology in general has been so inflated. I don't know if anybody caught the takeover of Deliveroo by Amazon on Friday. The company that was doing, from all customer points of view, was doing very, very well. Clearly, it overextended itself. It had grown too quickly. It only takes a change in market sentiment, and that model dies. You've really got to be about building, back to some sense and some building some fundamentally sound businesses with a sound idea that can make you some money, turn over good money in a shorter time frame.
I think just last thing, good luck to all the guys on the call. I mean, you people are all at the coal face, so I'm fully aware that sitting in the ivory tower is a little bit easier. So we wouldn't be building our business without the hard grit of people really building kind of with their customers. So appreciate the trying times, and as mentioned, if anyone wants to reach out to me or discuss anything, we're available to talk anytime.
That's very kind. Thank you, Nick. This is recorded, so we'll be uploading this onto YouTube and be circulating this as well. Nick, thank you very much for your time. It sounds like it's probably feeding time at your house. Simon, thank you very much for joining all the way from Israel. Albeit communications really don't make a difference where we are at the moment. But gentlemen, thank you. Thank you to everyone for joining as well. I hope you found this as insightful as I did. And hopefully we'll see you next week. Thank you very much.
Thanks, Darren. Thanks, Nick.
Take care. Bye-bye.